Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. Getting into your first home has always been a dream for many Australians. And with major changes now in effect, that dream might be more achievable than ever before. In today's episode of A Bite from the Money Sandwich, I'm joined by Chaice Paterson from Low Deposit Homes. Based on the Gold Coast, Chaice has made it his mission to help first home buyers navigate the entire process of getting into their first property, from savings plans to securing land and home packages even. We talked through the huge changes that came into effect on October 1st with the expansion of the first home buyer guarantee. You'll learn how first home buyers can now get into the market with as little as a 5% deposit, what grants and schemes are now available, and how to avoid the common mistakes that stall so many buyers. Whether you're aiming for a city apartment or your own slice of land, Chaice gives practical and easy to follow tips to take advantage of these unprecedented opportunities and finally get on the property ladder. Well, Chaice, welcome to the show.
No, thank you for having me.
So I always like to start with trying to get a bit to know about you and about why this is your particular career, because, everything I've been reading about you so far is, you are the go-to person, especially when it comes to first home buyers
Thank you.
information. So, what led you into this direction?
So basically, went to university, always had an interest in finance. I knew I was going to end up in that space in some way, shape or form. So did the degree, ended up going more so into financial planning, but was more interested in the property aspect. Bought my first property at quite a young age. So I was 19 when I bought the first property, and I knew that was the vehicle that I wanted to go down. So I ended up becoming a mortgage broker. Now, I was a very, very young mortgage broker in the space, and inevitably I was dealing with a lot of my cohort, which was my age. And, the number one topic that everyone wanted to know about was, how do you buy your first home? So what I realized was, I could help out from a finance standpoint and say, okay, cool. These are the steps that you need to take in order to be finance ready. But that's just one part of the process. And we're missing out on being able to help people through that entire process. So people were basically getting the information, okay, cool, this is the numbers I need to work to, but what do I do next? So that's where we saw the gap in the market and basically said, okay, well, we can basically help out on a buyer's advocacy front and guide first home buyers through that process, guide them through what grants that they're eligible for, how do we bridge the deposit, and how do we get people into their own homes years faster? And that was basically the opportunity that we recognized, and that's where Low Deposit Homes was born.
Okay. And I've often talked about this on this podcast for people when they're buying property. It's, for me, the biggest potential mistake people can make, because you're not buying a property for 50,000, you're buying a property for 500,000, $1 million or more. So it's really important to get good advice, but there are experts out there who can actually take you from woe to go. And that sounds like what you're doing. And I just think it's just such a great asset to have, to be able to help people, not just at the beginning, but the whole process, because there are just so many different areas along that journey that can go wrong.
Yeah. And I've got tons and tons of stories of where, when I was just in the mortgage broking by my, that period of time by myself, people would go out, they'd talk to a real estate agent, they'd end up signing an unconditional contract without understanding what that meant. They weren't handing the contracts to the solicitor for review before anything. So there's all these little mistakes that we were seeing that people could make. And it was basically saying, okay, it's our job to basically create that system as to what you need to do at every single stage to make sure that you are protected. And with our clients, when we onboard them, that's something that we talk about a lot. We have a very, very strict process, but that process is there to make sure that the buyer is protected throughout the entire process, and to get them from where they start to, basically turning that key and moving into their own home in the most efficient way possible, but also in a way that they are protected throughout the entire process. And that is something that we are so strict on, because we need to be able to guarantee that result to the buyer.
Excellent. You actually started with saying your first property as a 19-year-old.
Yeah.
That you weren't quite with your peers who were probably the first one to have done that. So, for me, it's always just fascinating people buying their first property. What made you think as a 19-year-old, "Yep, this is what I wanna do"?
So, mum and dad owned a couple of investment properties, and I'd seen, just out of interest, what they purchased it for as opposed to what it was worth, 15 years down the track. And you see these numbers, double or triple, and I was going, okay, that is the fastest way for me to become wealthy in my own right. So, I started working part time, when I was at school, from 15 years of age, and I was lucky. I was living at home. And my parents basically said, if you're banking all your cash, we won't charge you board or anything like that. If you can manage your money responsibly, it's all systems go for yourself. So I was very, very lucky in that sense. I got provided with the opportunity where I could just hoard as much cash as I could. And that's what allowed me to save the deposit for my first house.
Yeah, it's very mature thinking for a 19-year-old. I'm just thinking of my own self at 19, there was no way I was thinking about buying a property, but I get, you were surrounded by that, so you're able to understand that situation. So no, it's, very impressive. Uh, and I actually think you touched on something that we will cover, especially with the sandwich generation, that you're able to stay at home, you're able to save, and that's we're seeing far more with people who are my age with their adult children. Especially, COVID sort of brought that forward. So we'll talk about that, but let's just get into the first home guarantee scheme because it's 1st of October. There's some really big changes,
Massive changes.
but why don't we just talk about what was it before and then what happened on the 1st of October, please?
Yeah, absolutely. So, for example, if we were looking at it previously, so pre-October 1 this year, if you were looking at buying, whether it was brand new or an established house, I'm just going to use Brisbane's median house price of $1 million. If you're looking at buying a house at $1 million this time last year, you would have needed $122,000 for funds to complete. So that covers your 5% deposit, your stamp duty, your lender's mortgage insurance, legals, and all other purchasing costs.
Okay,
Whereas
and so just on that, you could do it with 5%, whereas normally most people, if they're buying a home, usually the bank are looking at 10 to 20% unless you do the insurance.
Correct. So, lender's mortgage insurance was a part of that process. But even when a bank was saying it's a 5% deposit, in real terms, you're looking at 10 to 12% by the time you factored in your stamp duty and all your other purchasing costs.
Yes.
Whereas now, if we're looking at it in Queensland, if you're looking at a brand new property, they've now abolished stamp duty as of last year or earlier this year. Sorry, so no stamp duty. And now, as of October 1st, there's no lender's mortgage insurance. So what that means is that same property, if you're looking at a brand new property, you could purchase that with $54,500. So
Gee,
it's
less than
greatly
half.
reduced. Yeah, it's greatly reduced the barrier to entry. Now, the benefit that I also see is, let's say we're dealing with a client who has 150 or 120K, they've saved up the larger deposit. What it means is that they're now putting more money into the asset itself, which is now lowering the loan, which is lowering the repayments, which is now putting that person into a much stronger financial position overall. So that's the real benefit that I see, is that you have less money being chewed up in taxes and costs that don't benefit the buyer.
Right. Uh, and also there are changes to uh, how much you can borrow too. Also, what the upper limit is.
Yeah, correct. So previously, say in Queensland, it was 700,000. That's now been raised to $1 million. In Victoria, that was previously at 800K. It's now up to 950,000. So those pricing caps has made a huge difference. Sydney, they've now increased it to 1.5 million. Which again, it just opens up more opportunities within the market, and that's again going to allow more people to be able to take that opportunity to be able to buy.
And the one thing, and something I always get asked, is that if now it's been safe going up to 1.5 million now in Sydney,
Yep.
do you see, coming into the summer, this is the busy time for people buying properties, that people are now saying, well, okay, this is now my new target. And, everyone will be looking at that. So, potentially that could drive up prices. And so what do you think about all that?
Yeah, look, it's a great argument. So the counter argument that we've seen. So whenever we've seen grants like this, we were looking at it in a period of time where we had super low interest rates. So whenever banks are looking at how much they can lend to someone, it's the rate that the person's offered plus 3%. So in previous times, when they've had grants like this, and we've had interest rates at all-time historical lows, the borrowing capacity of people was so strong that they could spend obscene amounts of money. Now we're sitting at a more historically normal interest rate. So the fact that we're sort of there and the prices are at an all-time high, people's borrowing capacity needs to be enough to be able to justify or to be able to be approved to be able to buy a home at 1.5 million or $1 million. Now, when we look at that as a percentage basis of the current population, it's a much smaller percent than what people think. So what's going to happen is there'll be lots of competition sort of at your entry level point of property prices. But the thing is, there always has been and there always will be. But as you start getting more towards $1 million plus mark, the amount of people who can afford to buy those, especially too as a first home buyer, because they're taking out a debt of $1 million plus, is going to be a much smaller amount of a much smaller amount of the population.
Yeah, no,
So
that makes sense. No, I like that. And if someone, because I've never had to do this, but if someone actually said, okay, yep, that what you're saying makes sense, I'm in that situation,
yeah.
is an actual online form? What's the actual logistics of actually applying for this scheme?
For this game, cool. So basically what happens is it's run through a multitude of different banks. So if we're looking at the majors, you've got Westpac, CBA, NAB, they're all on the scheme. So depending on which bank your broker or which bank you're going to, that will help you apply for a spot on the scheme on your behalf. So what basically happens is you'll get the conditional approval or the pre-approval that basically says, yes, based on your criteria of your income versus debts versus deposit, we're happy to lend to you. At that point in time, they'll then apply for a spot on the scheme, at which point you're given your unique code, and then your spot is applied for, and then upon settlement, the LMI is waived.
Okay. Okay. One thing I wouldn't mind, because you actually said it then, when you about going to any of the majors, but you can also go through a mortgage broker. As you said, you started off as a mortgage broker, and I've always believed that even if you're still going to use one of the major banks, that a mortgage broker is more there for you, whereas the banks are really, if you've got a bank manager who's provides you a loan, 6 months later, they're probably not going to be there. They've moved on. Whereas a mortgage broker, you can build a relationship. So I even think, even in this situation, I imagine building a relationship with a good mortgage broker would be preferred.
Absolutely. So the benefit that you have, say, in a broker or a good broker, is that they have an understanding of all the different bank policies. So you might go to one particular bank and they say no, because of genuine savings, you don't meet the policy. So because of that, you can't get the loan for 3 months. Whereas bank number two might look at it and they go, no, that's not correct. We can use your rent ledger. We can, satisfy it in this way or that way. And then all of a sudden, you've now got the opportunity to buy immediately. And especially too, when we're in a rising market, that difference of 3 months or 6 months to be able to buy, you're talking 50 to 100, plus $1,000 worth of equity that you could miss out on just by getting ill advice. So, a good mortgage broker that has a really strong understanding of the policies, and especially too, it's going to the right brokers who have the niche understanding of the policies for what it is that you're looking to do.
Things like HEX debt and all these things that will be for a lot of people who are first home buyers, they will have student debt, things like that. And some banks look at it differently to other banks.
Yeah, like CBA was the first to break with the HEX policy. So they've got a policy whereby if you're likely to have paid off your HEX by the end of the year, they actually wipe it in the serviceability calculator. NAB's just come out with a policy that's quite similar. So it's a really interesting time. You're seeing a lot of policies shifting and changing, especially too within the marketplace. So having someone who's educated on what those policies are is critical. Because if you go to someone and they don't know about that policy, that could be the difference between you being approved or not being approved for that home.
And what are some of the, I don't know, some of the things, let's look at tips and also the common mistakes. So let's just look at tips.
Yeah.
A lot of people, and you were saying about yourself even, living at home longer, saving, being able to save a deposit. I know when I talk about this that for my age group, a lot of us have equity in our home, so we can use that equity to help with the deposit
Yeah.
even if, of course, a lot of people, you still got to come up with the 5%. So
Yeah, for sure.
that's one of the hardest things to do. What are some of the tips, say, that parents can help with, or that you see could be for people looking at this for a first
Yeah.
home?
So parents have basically got two primary routes that they can assist in. So one is the family guarantee. So whereby if there's equity within their home, they can actually use that equity to provide as a deposit for their children. So a guarantee back in the day was a very brutal document. So the bank basically took a guarantee over the entire asset of the home. So if your kids failed to repay, they would take the kids home, and they also had the ability to take the entirety of the parents' home as well. Whereas now what's happened is because parents lending to kids is such a common thing, they had to change the policies around that, or else no one was willing to do it. And I completely understand why they weren't. So what they've done is they've changed it to what's called a limited liability guarantee. So let's say, for instance, someone was buying a house at 750,000. The deposit for that for 20% is 150K. So what they're doing is they're looking at mum and dad's property. They go, okay, cool. We can see that there's $150,000 of available equity here. We're going to take the limited liability guarantee for that portion of equity, and that is going to be used for the kids' deposit. Now, if the kids were to skip off to Bali and never come home and never pay their mortgage, the way that it works now is that they will sell the kids' asset first. And if there is anything remaining or left over, so let's say, their house had increased in value, that 150,000 guarantee that was provided was down to 30,000 due to a rising market. The parents now are only on the hook for 30,000. So the way that it's written and the way that the policy is done is far more fair and far more beneficial. What we're seeing is, on average, I think Westpac released a statistic. They're talking about the average family guarantee lasts for about 4.5 years, because you've got the mix of the property prices rising, plus then the people paying off the debt. And once the kids basically own that 20% portion, the guarantee is automatically lifted against the parent's property. So it's a far better instrument to use than what it previously was.
Yeah. Now, I've often discussed this about, because a lot of parents think they are up for the whole loan,
Yeah, yeah.
and I just said, I must admit, I thought it was 2.5, 3 years, but you've got the stats there for 4 years. That's it. Just over a period of time, that liability will just drop off. Do you actually have to, from a logistics, go in there and tell the bank, can we get this reviewed so that we can do it? Or does it just drop off after a number of years?
It does automatically drop off after a number of years. But if you were wanting to get it removed faster, the easiest way is get the property valued,
Yeah.
the kids' property. And, if they can see that their equity position is there, you can apply to have it removed earlier.
I think it's just one of the best things. Parents, if they're sitting on a home, got equity in that home, they can absolutely help their kids with that, because, if they can afford the loan repayments, it's normally the deposits the hardest part.
Correct, correct. And look, it is an absolute game changer. If we have clients who have their parents' support, the likelihood of them succeeding is, way, way higher. They're able to get into the market years faster. They've got that financial support. They've got a significant leg up. And I think we, as a nation, are coming into this period of time where, property prices will continue to rise. It's going to continue to get more difficult. And we're really going to experience the next generation whereby if your parents don't own property, your chances as the next home buyer are going to be severely diminished. So, being able to provide that leg up to the next generation is critical, because you're providing them the leg up so that they can then provide the leg up to the next generation after.
And I was also talking before about the sandwich generation. And one of the things of that sandwich generation is people in their 50s and 60s could live for another 30, 40 years.
Yeah.
So when you can actually help them, people say, oh, I'll leave my children an inheritance. They could be 50 or 60 by the time you leave them inheritance. They need the help now to get into their first home. And this is one of the very best ways to doing it. So I'm glad we've talked about that. What are some of the common mistakes you find for people who are looking to buy their first home that you see?
Probably one that we come across all the time, because we're very, very niched in first home buyers and the policies surrounding it, is people may speak to one person who's not an expert in the policies of that, get incorrect advice and think that they can't do anything. And then they sit on the sidelines for, months, while they get disheartened, and they might not attempt it for a year. When, you look at it and you go, no, you absolutely can buy. You just need to tweak a few things to put yourself in the position to be able to do so. So, if you have been told no, get a second opinion always.
Yeah, no, it's really important because when I first first bought our own home, you really never, mortgage brokers were less than 10% of the market. You
Yeah.
just traditionally went to your local branch and got to build a relationship with that local bank manager who could have been there for 10, 15 years. That's just
Yeah.
not the case. No, you need to go get that. And if one person doesn't have the right advice, yeah, absolutely, go get a second opinion. I like that.
Yeah.
Um, other mistakes people make, maybe going too far. They think the interest rates won't rise or something like that.
Look, say with that one, because of the level of debts that we're at, when you're looking at, say, Southeast Queensland, where, you've got a median house price in Brisbane of $1 million, the loans themselves are significant. So people are already very, very cautious to make sure that they're not going to the rev limiter. And we talk about it too. If I've got a young couple that don't have children, have you accounted for the fact that there is going to be a period of time where you're going to be on a single income? Is that going to be affordable, and is that going to be manageable? So it's just looking at all scenarios in that way. But I think people are very, very conscious of what the repayments are, knowing that they can make those, and that is a huge part of the decision making process.
How about people who want to think, because I know, buying your first home, it's a very, very emotional decision. So that's another reason why I say you should have experts who can be unemotional about this and do it logistically, from a logistics point of view. Um, what about going to auctions? You see a lot of people. Do you sort of see yep, we can provide that service, or we have experts that can go do that? Because you see people absolutely just getting the
It's
frenzy
one that
overbidding.
we have always steered buyers away from.
Right.
Um, there's a few things that we'll steer buyers clear from. So auctions being one. Off the plan apartments is another one. Purely for the fact that in a rising market, you're protected. The valuation increases. It comes to get the property valued. If you've got more equity, that's great. But say especially too when we're looking at Brisbane, 2018, 2019, there was a huge oversupply of apartments within the city. And it wasn't uncommon to see valuations, 50, 60, $100,000 short. And the issue is someone's already paid an unconditional deposit, and then they need to be able to cover that shortfall. So for us, again, reverting back to it, it's our goal to make sure that the buyer's protected the whole way through. So, we specialize in using the government grants and incentives. We specialize in new property, but we specialize in house and land because we can add in the protection clauses to the buyer to make sure that they are protected the whole way through.
Okay, talk to us a bit about the land and land and a house or land and property, because we don't see a lot of that in Sydney, but I know there are areas that you can do that. You can, as I said, also up in Southeast Queensland. So what is something, why should someone look at that uh, as a first home buyer compared to, say, an apartment, an already built apartment?
Yeah, for sure. Look, again, it's a lifestyle choice. So a lot of our demographic, they might have 2 kids, 3 kids. They want the standalone house. That's not to say that for them an apartment wouldn't be an appropriate choice. But again, too, because we're specialized in low deposits, how do we maximize the benefit so that we can put 100% of their savings into the asset itself? So, if we're looking at house and land, stamp duty is only calculated on the land portion. So the fact that there's no stamp duty, it means that a greater portion of their money is going into the house, and their deposit is actually going into getting them approved. Whereas when we look at, say, an established house or an apartment, you're paying a much higher amount of stamp duty. And that, for some people, that could be the difference or the barrier to entry for them to be able to get into the market.
Okay, so explain to me, when you're looking at, because you said it before about off the plan,
Yep.
and I get there's off the plan where there's a multitude, thousands of apartments, and
Yeah.
there's parts of Sydney that's like that. There was parts of Brisbane that were like that, and people who went in there overinflated prices, and there was so much competition. They really did lose if they wanted for trying to rent it or even trying to resell.
Yeah.
But this land and house, it's an off the plan, but it's different
It's
because
different in the way that the finance is done. So, say when you're looking at an off the plan apartment, it's generally a 10% unconditional contract upon signing. So you pay the 10% upfront, and then the apartment gets built, and then the valuation gets done, at a much, much later date.
Mhm.
So for house and land, generally the finance clauses allow for access to valuation. So then the asset can be valued. Once the asset is valued, you know that it meets the contract price. So the buyer's protected. They haven't put any money down where they're likely to lose anything. So there's always a protection.
And is that becoming quite popular for first home buyers?
For our market and our niche, it has been extremely,
Right.
because when you look at stamp duty on something that's say like 850,000 plus, you're looking at 35 to nearly $40,000. So that's an extra 35 or 40,000 that the person needs as a part of their deposit. Whereas under the new 5% scheme, if someone's looking at an $850,000 asset, accounting for legals, costs, all purchasing costs, they only need 45,000 to get in. So it gives them the opportunity to use all of their funds as a part of their deposit.
Okay. So, um, any other tips you see? You said you've had some horror stories. Is there something there that you sort of that the listeners could sort of say, okay, that's something I should at least tell my adult children, or if my adult children are listening, that just say, yep, okay, these are the sort of things I should be looking at.
Look, basically, whenever you're looking at house and land, you have to be very, very conscious as to what is actually being included within the contract itself. So, um, builders have built an entire industry on bait advertising. So showing an advertisement, and it basically says, buy this house from, and that's the danger word, is that from price, because for that you're literally getting 4 walls and a roof and not much else. So then what happens is you have to add in site works, driveways, allowances, all your kitchens, bathrooms, everything that makes the house a home. And then that price that you thought was the from price actually ends up being $100,000 more. And that's where people can be on the hook for a lot of money that they weren't anticipating. So it's really having an understanding of the contract, what's included. Is that a true fixed price contract? Is there allowances within the contract that will allow for that contract price to change? And making sure that everything is locked down in advance so that you know exactly what that end price is. And that's a big service that we offer to the clients, is basically going through that with them to ensure that they do have a fixed price and a turnkey product that allows them to move into that home with no additional repayments. Because again, there's no point in buying an asset that at the end of the job, you've got to spend an extra $50,000 or $60,000 to complete the home. Because all that's doing is it's just putting a first home buyer into a really bad or a dangerous financial situation, which we cannot have. So, we're using this as a product in order to get buyers into the market years faster, but we need to make sure that everything is locked down so that when they are getting in, they've got the result. They're not paying extra money that they don't need to, or that they hadn't anticipated.
No, thank you for that. What about the situation, because especially in Sydney, uh, prices are higher, and a lot of people were sort of saying, well, I'm going to give up because I can't afford 1 million or 1.2 million. So I'm just not going to do anything. And I would always say, well, maybe your first property is a 700 or 800,000 investment property.
Yeah.
And at least you're in the market, you're building a deposit, you're building an asset. But with these changes and the increased limit up to 1.5 in Sydney, and as you're saying, the no stamp duty, I imagine your argument is there is a lot more opportunity to get into your own home because, of course, your own home is capital gains tax free. You're not paying rent, so it's absolutely the ultimate, the optimal thing to do. Is that where is there anything like that, or do you sort of say some people, no, you really should do the investment property first?
Look, there's definitely some instances where people are going to be better suited to a rent vesting strategy. Based on what they have, they may be an hour and a half from their work. They may be, miles and miles away from their kids' schooling, and they don't want to disrupt their kids' schooling. There can be a multitude of different reasons. If they've got the deposit that's required, an investment property may be the best option for that person. It really just comes down to looking at the individual and saying, okay, cool, based on your lifestyle, your factors, where you are in your life, what is going to work best for you? And with these new grants, yes, the barrier to entry to be able to get into the market has dropped down significantly. but you still have to be able to afford those repayments. So if you're looking at an area of Sydney, and you're looking at buying a house at 1.3 million and you bought that on a low deposit, you are still servicing a debt of $1.2 million,
Yeah.
which, based on current market, if I was to do the math, I think it's around, $7,500, $8,000 per month. It's still a huge amount of money that is payable.
After
So for
tax
someone
money.
like that, they may be better off going, okay, cool. I'm going to continue to rent, or I'm going to, live in shared accommodation, or I'm going to live at home and I'm going to buy an investment property. I'm still in the market. I'm still getting the benefit. I'm still, capturing growth within the property market itself, but I'm not exposing myself to a huge liability in that way. Whereas for some other people, you might have husband and wife both making really, really good money. Their kids are a little bit older, and they can afford to buy using these graphs. And for them, that's the greatest strategy for them. But, there's really no one size fits all approach. And that's where, when we're looking at our services with clients, we can assess very, very quickly, is this going to work for you? Is this the right option for you? If it is, that's great. If not, you might be better off looking at this, or you might be looking at, be better off buying somewhere else.
And really, the thing I take from that, just like we've been sort of saying through the whole way through the show, is get advice. Get advice. Speak to people. You don't have to do this all on your own,
No.
and you don't want to make an expensive mistake. So that's really good. You must have probably the last question for me. Really, you probably have a lot of couples who might be coming into you, seeing you that, oh, okay, no, I've already got a property, but my partner hasn't. I don't know. Can you not get the first home grant then, or you can?
Really good question. So with regard to the 5% scheme and the first homeowners grant, no, you can't, because the way that it's written into the policy is it's based on the couple. Now, for a stamp duty exemption, that's different. So let's say my wife, I own property, my wife doesn't. We're able to put the title solely in my wife's name. So that way we're claiming a full stamp duty exemption on the asset because it's in her name. And then we're both going to be co-applicants on the loan. So that way we can still waive stamp duty, but you're not going to get the 5% scheme, no.
Gee, waiving the stamp duty is a great thing, though.
Yeah, 100%. If you can save yourself, 20 to 40 grand, it's great.
Yeah, no, I did not know that. So thank you for that. That's great. I always learn something every time. So no, that was really good. Okay, thank you, Chaice. It's been great. One thing I always ask my guest is the last question. You've told me already about your parents and then buying investment property, so you're able to learn from that. But what's, say, the very best piece of advice you've heard?
Ooh, that's a good one. Look, it's basically, whenever it comes to property itself, what I've seen, and it's just time and time again, if you're looking at you're buying in a major metropolitan area where there's limited supply, just buy what you can and get into the market, because you'll always see a positive return on that type of asset. We don't want to be buying, super regional where, it's more speculative. If you can buy in a major metropolitan area, you've got multiple sources of industry. There's always going to be more population coming to that area. It's always a very safe investment, and you always see that investment grow.
Like it. Yeah, really like it.
Yeah.
Hey, Chaice, well, thank you very much for being on the show, and we'll maybe get you back in 6 months to see how all this if the market's gone crazy with all these people buying properties or not.
Look, I feel like it's definitely brought more people into the market, but the fact that the pricing caps are so much higher, you are spreading that pool of buyers over a far greater area. Because previously they did have the 5% scheme, they were just at a much lower price point, which all it was doing was pushing more competition into the affordable housing stock, which was a bad policy. So the fact that they have raised the caps, it means that people who can afford $1 million or $1 million plus, they're likely to spend that, and the people who need to be able to afford less, they've got the opportunity to be able to get into the market without competing against that same pool of buyers. So overall, I do see it as a positive. But yes, the market will be crazy.
Yeah. Chaice, brilliant to have you on the show. Thank you very much for your time.
No, thank you very much. Cheers.
I hope you enjoyed this episode with Chaice and feel more confident about the recent changes that could help you or someone you know finally get into their first home. To find out more about Chaice and low deposit homes, visit lowdeposithomes.com.au. And as always, if you have any questions or would like more guidance, you can email me at admin@themoneysandwich.com or head to our website at themoneysandwich.com. Want more practical, easy to understand tips and action lists to help with your money stuff? The latest version of my book, The Money Sandwich, is now available to order on Booktopia and Amazon, as well as available at all popular bookstores. Everyone deserves to retire comfortably and on their own terms. Make this the year you take action. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.